Welcome, everyone, and thank you for joining today. We are diving into an easy to follow guide on how to remove the volume indicator in RTrader Pro. This is going to be a fun and straightforward process that will help you clean up your chart, making it more focused and tailored just for you. Stick with me, and by the end, you will know exactly how to remove indicators like volume and make your trading experience a lot more enjoyable. Have you ever looked at your trading chart and felt overwhelmed by all the data in front of you? Sometimes all those indicators can make it hard to focus on what really matters, the price action and the patterns it forms. Today, we are going to strip things back to the basics, starting with the volume indicator, and then dive into the fascinating world of chart patterns. Understanding these patterns can unlock insights into market behavior and help you make more strategic trading decisions. So let us take a moment to understand what the volume indicator does in RTrader Pro. If you have seen bars at the bottom of your chart, that is the volume indicator. It shows how much of an asset is being traded over a given time. For some, this is important information, but for others, it just makes the chart cluttered. Sometimes simpler is better, and that is exactly what we are aiming for today. Now, let us also expand our understanding by talking about different chart patterns that you can use to enhance your analysis. Chart patterns are visual formations that occur on price charts and can help you make predictions about future price movements. Some common chart patterns include head and shoulders, double tops and bottoms, triangles, flags, and pennants. Understanding these can be extremely helpful for traders of all levels. For instance, a head and shoulders pattern often signals a trend reversal, while double tops and bottoms indicate levels where the price has tested twice and failed to break through, which can signal a potential reversal. Another popular pattern is the triangle pattern, which can be ascending, descending, or symmetrical. These triangle patterns generally indicate periods of consolidation, and when the price breaks out of the triangle, it often leads to significant movement. Flags and pennants, on the other hand, are continuation patterns that signal the price is likely to continue in its current direction after a short consolidation period. Recognizing these formations can help you make informed decisions when buying or selling. Candlestick patterns also play an important role in chart analysis. Patterns like the hammer, shooting star, and engulfing candles can provide a lot of insight into market sentiment. A hammer, for instance, suggests that buyers are starting to gain control after a downtrend, while a shooting star indicates potential bearish reversal after an uptrend. By learning and recognizing these different chart patterns, you can better understand the dynamics of price movements and make more strategic decisions. Keep practicing spotting these patterns, and over time, you will find it easier to anticipate possible future market behaviors. Let us continue to explore how simplifying our charts by removing unnecessary indicators can make spotting these patterns even easier and more effective. So why might you want to remove the volume indicator? Maybe you prefer focusing on the price itself. Perhaps you use different indicators that fit your strategy better, and having that extra volume data is more of a distraction than a help. By removing unnecessary data, you are simplifying the chart, which can make reading and reacting to price changes faster and easier. Let us get into the steps to make this happen. To begin, open up your RTrader Pro platform and load the chart that you want to adjust. Make sure that the chart is visible on your screen. Go ahead and locate that chart now. Got it? All right, now take a look at the toolbar at the top of the screen. You should see an option labeled Indicators. This is where all of the fun happens. While we are here, let us also think about how we can incorporate chart patterns into our analysis to make our trading decisions more informed and strategic. Chart patterns are key tools for predicting price movements, and having a clean chart can help you spot these patterns more easily. For example, the head and shoulders pattern, which looks like a peak between two smaller peaks, is a reliable signal of a possible trend reversal. When you see this formation, it might indicate that the current trend is losing momentum. Similarly, double tops and bottoms are formations that signify an asset has tested a certain price level twice and failed, suggesting a potential change in trend direction. Another powerful chart pattern to recognize is the triangle pattern. This pattern can take several forms: ascending, descending, or symmetrical. An ascending triangle suggests that buyers are gaining strength and might eventually break through resistance, while a descending triangle signals the opposite, with sellers likely to overpower buyers soon. Symmetrical triangles often indicate that a breakout is imminent, though the direction can be either up or down, so keeping a close watch is crucial. Flags and pennants are also essential patterns that signify brief pauses in a strong trend. When price action forms a flag or pennant, it usually means that the market is taking a brief pause before continuing in the same direction. Recognizing these continuation patterns can help you stay in a trade longer to capture more profit. Candlestick patterns like dojis, hammers, and engulfing patterns also provide valuable information about potential market reversals or continuations. A hammer, for instance, is a bullish reversal pattern that occurs after a decline, showing that buyers are stepping in to push prices higher. On the other hand, a shooting star, which looks like an upside-down hammer, is a bearish signal often found at the top of an uptrend. By knowing these chart patterns and incorporating them into your analysis, you can improve your ability to predict future price movements and make more confident trading decisions. Now, let us proceed with removing the volume indicator so that we can make it easier to identify these chart patterns without distractions. Once you click on indicators, you are going to see a list of everything that is currently on your chart. This includes volume as well as any other indicators you have added. Take a moment to look at that list. Do you see the volume indicator there? Perfect. Click on it. Once you select it, you should see an option to remove or delete it. Click on that option, and just like that, the volume bars will disappear. See how simple that was? Now you have a cleaner chart that is ready to be customized further. All right, let us talk about what we can do now that our chart is less cluttered. With the volume indicator gone, you have a fresh canvas to work with. You might want to add something else that is more useful for your trading style. Return to that indicators menu and take a look at what is available. Maybe you want to add a moving average to get a better sense of the overall trend. Moving averages are great for smoothing out price data to identify the direction of a trend. You could use a simple moving average or an exponential moving average, depending on how sensitive you want it to be to recent price changes. Another effective indicator to consider is the relative strength index, which helps you see when an asset might be overbought or oversold. The relative strength index is a momentum oscillator that measures the speed and change of price movements, making it a valuable tool for finding potential reversal points. When the relative strength index crosses above 70, it indicates that the asset might be overbought, while a value below 30 can mean it is oversold. Additionally, consider incorporating Bollinger Bands. Bollinger Bands consist of a moving average with two standard deviation lines above and below it. These bands expand and contract based on market volatility, giving you an idea of whether prices are high or low on a relative basis. This can be useful for identifying potential breakout opportunities or to see if the asset is consolidating. You might also look at support and resistance indicators to identify key levels where price has historically had difficulty breaking through. Knowing these levels can help you make strategic entry and exit decisions. For instance, when an asset nears a support level, it might be a good opportunity to buy, assuming the price is likely to bounce. Fibonacci retracement is another tool that can help you identify potential reversal levels based on mathematical relationships found in nature. Many traders use Fibonacci retracement to identify points where a pullback might reverse, giving you an idea of where to place stop-loss orders or identify price targets. Whatever fits your style, this is the time to add it. Think about what will help you the most given your trading strategy. Keep experimenting and remember that the indicators should work together to give you a clearer picture rather than create confusion. The goal is to make your chart informative without being overwhelming, and each indicator should serve a specific purpose. After you have made the changes, be sure to save your chart layout. Saving it will keep all of your adjustments in place so that next time you open the platform, everything looks just the way you want it. You should see a Save Layout button somewhere on your screen. Click that to make sure your hard work is saved. This small step can save you time down the road. Let us quickly cover some troubleshooting tips just in case things do not go as planned. Maybe you try to remove the volume indicator and it does not disappear right away. If that happens, do not worry. Sometimes the platform might lag a little, or there could be a small glitch. A quick refresh of your chart or even restarting RTrader Pro should do the trick. If you find that an indicator is still not behaving correctly, double-check that your platform is fully updated to the latest version, as outdated software can sometimes cause unexpected issues. Another common issue is that certain indicators might be linked together. For instance, if the volume indicator is tied to another setting, you may need to adjust that related setting before the volume will disappear. Always check if there are any dependencies listed for the indicator. And if you accidentally removed an indicator that you actually wanted, you can easily add it back. Just go back to the Indicators menu and reselect it from the list. No harm done. Also, if you add an indicator back, but it looks different than before, it might be using default settings. Feel free to go into the settings and tweak the appearance or parameters to match what you had before. Now let us take a step back and think about why removing the volume indicator could be beneficial for you. One big reason is clarity. A cleaner chart means fewer distractions. With fewer things to look at, you can focus on the indicators that really matter to your strategy. If you are watching the price action closely, a less cluttered chart can help you spot patterns and make decisions faster. This is especially helpful if you are making quick trades and need a simple, clear view. Every trader has different needs. If you are a day trader, for instance, you might appreciate having only the bare essentials on your screen. You need quick and concise information to make decisions, and removing volume might help you stay focused. On the other hand, if you are a swing trader, you might prefer to keep the volume to help you confirm longer-term trends. There is no right or wrong here, just what works best for you. Let us delve deeper into some of the most important chart patterns that different types of traders find useful. For day traders, Quick and actionable chart patterns are key. One popular pattern is the bullish flag, which indicates a brief consolidation before a continuation of the uptrend. This pattern can be used to enter a trade quickly before a breakout. Another important pattern for day traders is the bearish engulfing pattern. This occurs when a small green candlestick is followed by a larger red candlestick that completely engulfs it, signaling a possible downward reversal. Swing traders, on the other hand, often look for patterns that signal longer-term changes. The double bottom pattern, for example, is a classic formation that suggests a trend reversal after the price has reached a support level twice without breaking through. It indicates strong buying pressure at that level and could signal a potential upward trend. Another great pattern for swing traders is the ascending triangle. This pattern shows a series of higher lows that press up against a horizontal resistance line, indicating that buyers are becoming more aggressive and a breakout could soon occur. For traders who like to rely on trend analysis, wedge patterns are incredibly useful. Falling wedges typically indicate a bullish reversal, while rising wedges can be a bearish signal. Both of these patterns show a narrowing price movement, indicating a loss of momentum that eventually leads to a breakout in the opposite direction. Head and shoulders is another pattern that can be used by both day traders and swing traders, depending on the time frame. This pattern is characterized by three peaks, with the middle peak being the highest, the head, and the two outer peaks being lower, the shoulders. It often signals a trend reversal, and traders look for the neckline to break before entering a position. Candlestick patterns like morning stars and evening stars can also be critical for different types of traders. A morning star pattern is a bullish reversal pattern that often appears at the end of a downtrend and signals that the market sentiment is shifting in favor of buyers. Conversely, the evening star is a bearish reversal pattern found at the top of an uptrend and suggests that sellers are gaining strength. Recognizing and understanding these patterns can help you tailor your trading approach based on your specific needs. Day traders might prefer patterns that provide fast signals, such as the bullish flag, bearish engulfing, or morning star patterns, which allow for quick entries and exits. Swing traders, meanwhile, may look for more sustained formations like the double bottom, ascending triangle, or head and shoulders, which provide insights into medium-term trends and allow for more gradual decision-making. Understanding the context and time frame in which these patterns are most effective is key. For example, an ascending triangle is often used by swing traders who want to capitalize on a breakout after a consolidation phase, whereas day traders may be looking at quick reversal patterns like the doji or hammer for short, rapid trades. The wedge patterns, both rising and falling, are versatile and can be used by both day and swing traders depending on their setup. The falling wedge often indicates a potential reversal to the upside, making it an excellent entry point for those looking to catch the beginning of an uptrend. On the other hand, a rising wedge signals weakening momentum, which can be an opportunity for traders to exit or even enter short positions. Being thorough with these chart patterns also means understanding the psychology behind them. For instance, the head and shoulders pattern represents a change in sentiment from bullish to bearish, where the middle peak, the head, suggests an exhaustion of the current trend. Recognizing this shift allows you to prepare for a reversal. Likewise, the double top and double bottom patterns illustrate price struggling to break key levels, showing where buyers or sellers are stepping in repeatedly. This tug of war provides a clear picture of potential future movements. Candlestick patterns like the morning star, evening star, and engulfing candles also provide context into the sentiment driving the market. A morning star pattern is seen as a hopeful sign for buyers after a downtrend, showing that the bearish momentum is fading, while an evening star at the top of an uptrend indicates that buying power is losing steam. Engulfing patterns, both bullish and bearish, are strong signals of reversals, with the larger candle entirely swallowing the previous one, indicating a sudden shift in control. The ability to recognize what is most beneficial for your strategy and apply it in real time is what makes adjusting your chart so powerful. You need to think about what kind of trader you are, whether you prefer quick, reactive trades or holding positions to ride a trend. Each pattern has its own strengths and weaknesses, and knowing when and how to use them effectively can make a significant difference in your trading success. And that is why it is so great to know how to adjust your chart to suit your style. Imagine you are analyzing a price movement and all of a sudden, your screen is full of colorful indicators and bars. It might be overwhelming, right? By removing what you do not need, you can make your analysis clearer. For example, if you rely mostly on support and resistance levels, or if you like to use candlestick patterns, having an uncluttered chart will make it easier for you to see those levels and patterns develop. The goal of today is to give you control over your chart. Charts are not a one-size-fits-all tool. You should be able to look at your screen and instantly feel comfortable with what you see. If that means taking things away, then go ahead. If that means adding other indicators back in, go for it. Experiment and find what works for you. It is all about refining your setup and making it yours. By now, you should be comfortable with the idea of removing the volume indicator and adding anything else you might need. It is simple, and as you do it more, it will become second nature. If you have questions or need more help with other indicators, feel free to reach out and ask. There is always more to learn, and I am here to help you along the way. Remember, a clean chart can lead to clearer decisions. Trading is about making the best decisions possible, and if simplifying your screen helps you do that, then it is definitely worth the effort. Keep practicing these small adjustments, and soon you will be able to tweak your charts without even thinking about it. Thank you for being here today and for taking the time to learn something new. Stay curious, keep adjusting your setup, and make it yours. You have got this. Keep those questions coming, and let us keep learning together. Happy trading.